Most traders think the market is random. 1 minute price is going up, the next minute it suddenly reverses, and it feels almost impossible to know where the turning point will happen. But what if you had a tool that could consistently highlight the areas where price is most likely to pull back or reverse? In this video, I'm going to show you a strategy that, when used correctly, can help you identify extremely precise reversal zones. The same type of zones where price has reacted again and again across the charts. And the tool we're using for this is something you've probably already seen before, the Fibonacci retracement tool. The problem is not the tool itself. The problem is that most traders apply it completely wrong. They draw it randomly, they use the default settings, and then they wonder why it doesn't work. Today I'm going to show you how to set it up the proper way, the exact settings I personally use, and a step-by-step strategy that combines Fibonacci with market structure to create high-probability entries with tight stop losses and strong risk-to-reward. Let's start with the setup. To begin, open your chart on TradingView. Once the chart loads, direct your attention to the vertical toolbar on the left side of the screen. This panel contains all the drawing and analysis tools used for technical charting. Locate and select the Fibonacci retracement tool. After selecting it, place the tool anywhere on your chart and then open its settings panel to customize the levels. Most traders simply leave the Fibonacci tool on its default settings, which is one of the main reasons they fail to get consistent results from it. Instead, we're going to refine the levels so the tool highlights the most important retracement zone used in this strategy. Inside the settings menu, remove the unnecessary default levels and replace them with the following values. Once these levels are applied, your Fibonacci tool will display a more focused structure on the chart. Rather than showing a large cluster of levels, it now highlights a specific retracement range that matters the most. The area between 0.618 and 0.79 forms what many professional traders refer to as the golden retracement zone. This zone represents the region where a trending market most commonly pulls back before continuing in the original direction. In other words, when price makes a strong move and then begins to retrace. This range is statistically one of the most likely areas where buyers or sellers step back in the market. Because of this behavior, experienced traders often watch this zone very closely, waiting for confirmation that the trend is ready to resume. This is how the Fibonacci retracement is usually used. When the market is trending upward, you draw the Fibonacci tool from the swing low to the swing high. This maps out the potential retracement levels. When price begins to pull back, traders watch the golden zone for signs that buyers may step back into the market. If price reacts there, the typical approach is to place a stop loss slightly below the zone and aim for a take profit near the previous highs. On the surface, this idea actually works fairly often. If you test it across charts, you will see many cases where price respects these levels almost perfectly.
Is there a problem?
Big problem.
Sometimes price completely ignores the golden zone. Instead of bouncing, it slices right through it and keeps falling. When that happens, traders who enter too early are left holding losing positions. So the real question becomes, how do we increase the probability that the Fibonacci zone will actually hold? To solve this problem, we need to add context to the Fibonacci setup. So instead of blindly trading every golden zone, we add a simple framework that tells us when that zone actually matters. The first thing we always check is the higher time frame trend. Move to a higher chart, such as the 4-hour or daily time frame, and determine the overall direction of the market. If price is consistently creating higher highs and higher lows, the market is in an uptrend. If it's producing lower highs and lower lows, the market is in a downtrend. This step is important because we only want to take trades in the direction of the dominant trend, not against it. Once the trend is clear, the next step is to look for fair value gap, an FVG. A fair value gap forms when price moves aggressively in one direction, leaving an imbalance between buyers and sellers. Visually, it usually appears as a strong impulsive candle where the candles on either side leave a small gap between their wicks. That gap represents an area where the market moves so quickly that not enough trades occurred there. Markets tend to revisit these imbalanced areas later to rebalance orders. Because of this, fair value gaps often act as high-interest zones where price may react. Now, this is where the strategy really starts to come together and show its real strength. Once you've identified a fair value gap that sits in the direction of the higher time frame trend, the next step is to measure the move that created that imbalance. This is where the Fibonacci retracement becomes extremely useful. Take your Fibonacci tool and draw it from the beginning of the impulsive move to the end of that move, essentially measuring the push that created the gap in the first place. What this does is reveal the natural retracement levels of that impulse. And here's the key moment. If the Fibonacci Golden Zone, that area between the deeper retracement levels, overlaps with the fair value gap, you suddenly have something far more powerful than a single indicator. You now have two independent pieces of market logic pointing to the exact same area. On one side, the fair value gap represents an imbalance in the market, a place where price moved too quickly and often wants to return to rebalance orders. On the other side, the Fibonacci retracement highlights the natural pullback levels within a trend, areas where institutions frequently re-enter positions. When these two zones align, they create what traders call confluence, multiple reasons for the market to react at the same level. And in trading, confluence is where probabilities start to shift in your favor. Instead of guessing where price might turn, you're now identifying precise zones where reactions become statistically more likely. At that point, the approach becomes very simple. Patience. You don't chase price. You don't force entries. You simply allow the market to retrace back into that overlapping zone. When price finally reaches that area, where the fair value gap and Fibonacci Golden Zone meet, that's when you start paying close attention to the behavior of price. If buyers step in and momentum begins to return in the direction of the trend, that's where your entry opportunity appears. Your stop loss can be placed just beyond the structure that formed the imbalance, giving the trade enough room to breathe while still keeping risk controlled. And your take profit targets can be aligned with the previous highs or with the continuation of the overall trend. What's powerful about this approach is that it transforms the Fibonacci tool from something many traders use randomly into a structured decision-making framework. You're no longer drawing lines and hoping the market respects them. Instead, you're combining trend direction, market imbalance, and retracement logic to locate areas where price already has a reason to react. Try applying this method on your charts and see how often the market reacts around these zones. You might be surprised how frequently price respects them. If this breakdown helped you understand Fibonacci in a completely different way, let me know in the comments. And if you want more strategies that combine price action with smart market concepts, make sure you subscribe because there's a lot more coming.